Welcome to Trader UK, where we discuss money management and how to grow your wealth. If you haven't done so already, go ahead and click on the subscribe button so these videos start to appear on your home page. Today we're going to look at investing in REITs. That's R-E-I-T-S, although it's pronounced REITs, R-E-E-T-S. And I'm going to show you how to do this, as always, using my preferred platform, Degiro. So before we get into how to buy or how to invest in REITs, we should run through what a REIT is. REIT stands for Real Estate Investment Trust, and it's a company that owns and manages property in order to generate income. And the key word here is manages. Take a property developer, for example, like Taylor Wimpey or Barratt Homes in the UK. They build houses and they sell them to generate profit. Throughout that process, they do not manage that property, and therefore they would not qualify for REIT status. So really, we're looking more at companies that own storage and then rent that storage or those storage units to you. Companies that own land and let it out, companies that own commercial property, shopping centres, for example, and these types of properties that they then let out and use to generate income. Now, that isn't to say the property has to be the only source of income, but it does need to be a substantial part of the business. Take a storage company, for example. They will let out their storage units, which is a direct income stream from the property. But most likely they'll also sell boxes, packaging, etc., materials for individuals to use, which is an indirect income source. This type of company can usually still obtain REIT status because the primary focus of the business is property related. It's an opportunity to invest in property without needing to own the property outright. This is one of the biggest problems with investing in property. There's some huge barriers to entry. Even if I have £10,000 to invest in property, well, that's not going to get me very far. First of all, the legal fees are going to take a big chunk of that 10,000, and what I'm left with won't even cover the deposit needed. Not to mention, if I have good credit and meet the criteria to secure a mortgage. Whereas when you're talking about a real estate investment trust, I can invest the full 10,000 very easily in the same way I would normally buy shares in a company. As well as this, when I eventually decide to sell, because they're traded on a very liquid market, I can sell my investment instantly and with very little cost compared to owning a physical property where you'd have to list it on the market, search for a buyer, and then again pay large legal fees in order to sell and cash in your investment. REITs don't pay corporation tax on property income. Now, if we think back to our house builders like Taylor Wimpey, Barratt Homes again, they build a house, they sell it, and they make a profit. They then pay corporation tax on that profit, and they might distribute what's left to the shareholders, who then declare it on their tax return, and those shareholders have to then pay a tax on the dividends that they receive. So it's like a double taxation. There are some caveats to this rule, like the tax relief only applies to funds that are distributed to shareholders, and the tax relief only applies to income generated directly from the property business and not the other business that they may partake in. But it does certainly mean if they're not paying corporation tax on these profits, it means that there are going to be more funds available to distribute as to its shareholders. And one other rule with the REITs, as you receive your dividends, you would actually declare those on your tax return under property income rather than as dividend income. Finally, a REIT must pay 90% of their property income in dividends. If you go and read a few articles on this, like I did, you'll see there's some debate over this, as the 90% rule is actually calculated from cash flow and not the profit and loss statement. So these two things can differ significantly. So a company, for example, could announce big profits per their accounts, per their profit and loss statement, but in cash flow terms, they could have a negative cash flow and therefore not have to pay out any dividends. But the general takeaway from this should be that these companies should be considered dividend stocks. They're going to pay out a large proportion of their income by way of dividend. They will be paying out large proportions of their earnings to ensure they maintain this REIT status and they keep hold of those tax benefits. Now I'm going to share my screen with you and show you how to find, how to research and how to invest in REITs via the Degiro trading platform. Now you'll notice on Degiro that there is no section for REITs. If you use the search function, it will give the option to search for shares, bonds, investment funds and ETFs. The reason there is no section for REITs is because they actually fall under shares. You would buy these and sell them in the same way that you buy and sell shares in any company. And the FTSE 100, for example, is made up of some companies that have REIT status. So all you really need to do is find out which companies that applies to. And the easiest way to do it is via a quick Google search. Here I search for UK REITs, and the first website, investmentproperty.co.uk, gives you a broad definition of what a REIT is, the tax benefits, etc., and then gives you a list of UK REITs. You can work your way through that list. They're all slightly different. Big Yellow Group, this is one that I've been looking at recently. They are a storage company, but again the majority of their business is made up in property, so they have REIT status. You have some student properties in here, student lets, Empiric Student Property for example. Land securities, they tend to be London-based commercial and office properties. So you can work your way through the list. You can visit the website for each one. This was Big Yellow, for example. They'll tell you exactly what they do, and they normally have an investors page, or there's a summary at the top here, £9.15 per share, down 4p today. So you can use that to do your background research, and then you'll just buy and sell in the normal way. So I should be able to search under shares for the Big Yellow storage, Big Yellow Group. There they are on the London Stock Exchange. So from our research we know that this company have REIT status. We know that they'll pay good dividends, and let's have a look at how they've performed. Apart from the recent blip for obvious reasons, they've been getting significant growth as well. So that's how you identify the REITs, but then you can just go ahead and buy them as you would buy any other company. I hope you found that useful, guys. If you did, leave me a comment. Make sure you hit the subscribe button as well, and I'll see you next time for another video.